There is a company so large that it does not need to own your house to influence your mortgage. It does not need to run your government to advise your government. It does not need to control every company to hold voting power across thousands of them. Its name is BlackRock. Most people have heard the name, but few understand the machine behind it. And the strangest part is this: the empire began with one man losing $100 million. In 1986, Larry Fink was a rising star at First Boston. He was young, aggressive, and convinced he understood risk better than the people around him. His specialty was mortgage-backed securities, financial products created by bundling thousands of home loans into investable packages. To Wall Street, this looked like genius. To Fink, it looked like a machine for printing money. But hidden inside that confidence was a dangerous assumption, that his models were right. Then he made the bet that almost ended him. Fink believed interest rates would move one way. They moved the other. He had bought protection, but the hedge was miscalculated. One mistake in the math turned a powerful trader into a liability. First, Boston lost roughly $100 million. In the hallways, the golden boy became radioactive. People stopped looking at him the same way. In finance, humiliation is not quiet. It follows you. That loss became the scar that built BlackRock. Fink learned a brutal lesson. The danger is not risk itself. The danger is risk you do not understand. He became obsessed with measuring what others guessed. What if a portfolio could be stress-tested before disaster arrived? What if a firm could see cracks before the market panicked? What if the real power on Wall Street was not trading harder, but knowing where the bodies were buried before everyone else? In 1988, Fink gathered a small team and pitched Stephen Schwarzman at Blackstone. The idea was not glamorous. It was institutional bond management built around computerized risk analytics. Blackstone gave the team funding, and the business quickly grew, but success created conflict. Fink wanted to give equity to attract top talent. Schwarzman resisted dilution. The partnership cracked. In 1994, the units split away, and the name BlackRock was born. Schwarzman would later describe selling BlackRock as a huge mistake, and it is easy to see why. What looked like a bond management firm was becoming something much more valuable: a risk machine. BlackRock was not simply trying to pick securities. It was trying to become the nervous system behind modern finance. The firm wanted to know what was inside portfolios, how those portfolios might break, and what disaster would look like before it arrived. At the center of that machine was Aladdin. The name sounds harmless, almost magical. But inside BlackRock, Aladdin became one of the most important financial technology systems in the world. It stands for Asset, Liability, Debt and Derivative Investment Network. Its job is to analyze portfolios, model risk, run scenarios, and ask uncomfortable questions. What happens if rates spike? What happens if oil collapses? What happens if the market freezes? Aladdin gave BlackRock something more valuable than a hot stock tip. It gave the firm credibility in a world terrified of hidden risk. When markets shook, BlackRock could say, "We have seen the portfolio. We have modeled the disaster. We know where the weak points are." That is a powerful sentence when everyone else is panicking. And over time, Aladdin stopped being just an internal tool. It became a product other institutions wanted to use. That is when BlackRock's influence began spreading beyond assets it directly managed. Pension funds, banks, insurers, central banks, and sovereign wealth funds could all use BlackRock's risk technology. So even when BlackRock was not technically controlling the money, its system could still be helping institutions understand the money. This is the first strange layer of the empire. BlackRock became powerful not only by managing capital, but by becoming infrastructure for people who manage capital. Then BlackRock went public in 1999. That opened the next chapter. Acquisition. Fink understood that scale was becoming a weapon. The more assets BlackRock managed, the more data it saw. The more data it saw, the stronger its systems became. In 2006, BlackRock merged with Merrill Lynch Investment Managers. Then, in 2009, during the wreckage of the financial crisis, BlackRock made the deal that changed everything. Barclays needed capital. BlackRock wanted scale. The result was the acquisition of Barclays Global Investors, and with it, iShares. That was the crown jewel. iShares placed BlackRock at the center of the ETF revolution. Investors were moving away from expensive stock pickers and into low-cost index funds. The pitch was simple: stop trying to beat the market, buy the market. And BlackRock became one of the biggest sellers of that idea. This is how BlackRock entered the Big Three conversation, alongside Vanguard and State Street. These firms became the giants of passive investing. They did not need to beat every company. They could own slices of almost all of them through index products. That sounds boring, until you realize boring is exactly why it worked. Retirement accounts, pension funds, advisors, and ordinary investors all poured money into simple funds that quietly became enormous. But passive investing created a question most people never ask. If millions of individuals own shares through index funds, who votes those shares? In theory, the investors own them. In practice, large asset managers often hold the voting power. That means BlackRock's stewardship team can influence board elections, executive pay, climate resolutions, governance rules, and corporate strategy across thousands of companies. The average investor gets exposure. BlackRock gets influence. This is where common ownership becomes controversial. BlackRock can hold shares in competing companies at the same time: Coke and Pepsi, Exxon and Chevron, Apple and Microsoft, Delta and United. The companies fight in public, but their largest outside shareholders can overlap. That does not mean BlackRock runs them like a puppet master, but it does raise a disturbing question. What happens when the same financial giants sit behind almost every rival? BlackRock's defenders argue that it is not using its own money. It is managing client money. They argue the firm is a fiduciary, not a secret government. Critics respond that voting power is still power, even if the capital belongs to clients. This tension is the heart of the BlackRock debate. Is it just a scale-efficient asset manager helping people invest cheaply? Or has passive investing accidentally created one of the most powerful voting machines in capitalism? Then came 2008, the crisis that made BlackRock look almost indispensable. The financial system was collapsing under mortgage products related to the same world Fink once helped build. Banks were full of assets nobody knew how to price. Washington needed someone who could understand the mess quickly, so policymakers turned to BlackRock. The firm was asked to help value and manage toxic assets when the government itself was desperate for clarity. That role made BlackRock Washington's emergency financial mechanic. The government needed help with assets tied to Bear Stearns, AIG, Fannie Mae, Freddie Mac, and other crisis-era problems. BlackRock Solutions stepped in to analyze, price, and manage complicated portfolios. To supporters, this proved BlackRock had unmatched expertise. To critics, it showed something dangerous. When the system breaks, the government calls the same private firm that already sits deep inside the system. And then it happened again in 2020. When COVID panic froze credit markets, the Federal Reserve hired BlackRock to help run emergency corporate bond buying programs. That included buying corporate debt and bond ETFs to stabilize markets. Supporters saw this as crisis management. Critics saw a conflict of interest nightmare. Because BlackRock was not just helping the central bank operate the program, it was also one of the biggest ETF providers in the world. This is how BlackRock became known as the firm governments call when markets catch fire. But that reputation creates an uncomfortable loop. The bigger BlackRock becomes, the more useful it becomes in a crisis. The more useful it becomes in a crisis, the closer it gets to government power. And the closer it gets to government power, the harder it becomes to describe BlackRock as just another asset manager. Yet BlackRock avoided being regulated like a giant bank. After the financial crisis, the phrase "too big to fail" became toxic. Big banks faced tougher rules. BlackRock argued that it was different. It did not take deposits like a bank. It did not mainly invest its own balance sheet. It managed client assets. That argument mattered, because if regulators accepted it, BlackRock could remain enormous without carrying the same burden as the banks. Then there is the revolving door. Former officials from the Treasury, Federal Reserve, and other agencies have moved into BlackRock. BlackRock executives have also moved into public roles. This happens across finance, not just at one company. But with BlackRock, the scale makes people uneasy. When the same people move between the firm that manages trillions and the institutions that regulate markets, the public starts asking, where does private influence end and public policy begin? BlackRock does not need a conspiracy to be powerful. Its power is structural. It comes from scale, data, technology, client relationships, voting influence, government usefulness, and the simple fact that modern finance rewards concentration. People want cheap funds. Institutions want risk systems. Governments want emergency expertise. Companies want access to capital. BlackRock sits at the intersection of all of it. That is more interesting than a conspiracy, because it is legal, rational, and built into the system. In 2018, Larry Fink pushed BlackRock into another battle, ESG. His annual letters told CEOs that companies needed a social purpose and could not ignore environmental and social consequences. Supporters praised him for forcing corporate leaders to think beyond short-term profits. But critics saw something else. They asked why one asset manager should become the moral referee for corporate America. And they asked whether ESG was principle or just another product. The backlash came from both directions. Climate activists accused BlackRock of not going far enough, pointing to fossil fuel exposure and limited real-world impact. Conservative officials accused the firm of pushing politics through pension money. Red states pulled funds. Public hearings turned hostile. Even the word ESG became radioactive. Fink later said he stopped using the term because it had become weaponized. The message was clear. Once you control too much money, every position becomes political. This was a warning about BlackRock's real problem. When you are small, you can choose a side. When you manage trillions, every side is your client, your critic, or your investment. Oil companies, renewable companies, governments, pensioners, retirees, activists, politicians, banks, regulators. The firm became so deeply embedded in the economy that neutrality became almost impossible. Even silence could be interpreted as a statement. Meanwhile, the ETF business that made BlackRock massive was becoming lower margin and intensely competitive. Passive investing won because it was cheap, but cheap products create pressure. The largest firms can survive on scale, but future growth becomes harder. So, BlackRock began leaning into areas where fees are higher and control is deeper. Private markets, alternatives, infrastructure, technology, and customized portfolios. In other words, the empire started moving from owning slices of public companies to financing the physical systems beneath them. Infrastructure is where the story gets even bigger. Roads, airports, ports, pipelines, power grids, data centers, water systems. These are not ordinary assets. They are essential. You can decide not to buy a stock. You can decide not to buy a luxury product. But you cannot easily opt out of electricity, transport, water, or digital infrastructure. That is why infrastructure can be so attractive to asset managers. It turns everyday necessity into long-term cash flow. In 2024, BlackRock completed its acquisition of Global Infrastructure Partners, one of the world's major infrastructure investors. That deal signaled where Fink wants the next BlackRock to go. Not just ETFs, not just public stocks, not just risk software, physical assets, airports, energy systems, transport networks, and projects that sit between governments, corporations, and citizens. If Aladdin made BlackRock the brain of finance, infrastructure could make it one of the landlords of modern life. Then came the ports. A BlackRock-led consortium agreed to buy a major global ports business from C.K. Hutchison, including ports near the Panama Canal. The headlines made it sound like BlackRock was buying the canal itself. That is not accurate. But the deeper point is still powerful. Ports are choke points in global trade. Whoever owns or operates key infrastructure near critical routes can influence logistics, shipping economics, and geopolitical perception. In infrastructure, location is leverage. BlackRock has also been connected to reconstruction and development conversations in Ukraine. That does not mean it owns a country. It means something more subtle. When nations need capital, technical advice, and access to global investors, firms like BlackRock are invited into the room. Wars destroy buildings, roads, power systems, and balance sheets. Reconstruction requires money at enormous scale, and BlackRock specializes in organizing capital at enormous scale. This is why the phrase BlackRock owns everything is both misleading and revealing. Technically, BlackRock manages money for clients. It does not own everything on its own balance sheet, but culturally people use that phrase because they sense something real. A single firm appears everywhere, in your retirement fund, in corporate shareholder lists, in government crisis programs, in infrastructure deals, in risk systems. Not ownership in the simple sense, presence in the strategic sense. The fear is not that BlackRock controls every decision like a cartoon villain. The fear is that modern capitalism has created institutions so large that their ordinary business activities become extraordinary power. A vote here, a risk model there, a government contract during panic, a seat in reconstruction discussions, a position in thousands of companies. Each piece can be explained, but when the pieces are stacked together, the shape starts to look like an empire. And yet, BlackRock's rise also solved real problems. It gave investors cheaper access to markets. It helped pensions manage risk. It built tools institutions depend on. It provided liquidity in crises. It made investing simpler for millions of people. That is what makes the story difficult. BlackRock is not powerful because it failed. It is powerful because it succeeded. The danger is not incompetence. The danger is competence at a scale society does not fully know how to supervise. Larry Fink's personal story makes the empire even more ironic. The man who built BlackRock was shaped by a mistake in risk management. He lost $100 million because a model failed. Then he built a firm designed to make sure powerful institutions never flew blind again. But by doing that too well, BlackRock became its own kind of risk. The company built to measure danger became so large that people now ask whether it has become a danger itself. This is the paradox at the center of BlackRock. Its clients want safety, scale, low fees, and expertise. Markets reward the firm for providing those things. Governments call it because it knows the plumbing. Companies listen because it represents enormous capital. But democracy becomes uneasy when private financial plumbing becomes too important to ignore. Nobody voted for BlackRock, yet in moments of crisis, its phone still rings. So the real question is not whether BlackRock is evil. That is too simple. The real question is whether any private firm should become this embedded in the operating system of global finance. What happens when the same company manages assets, sells risk technology, votes shares, advises governments, buys infrastructure, and shows up during emergencies? At what point does efficiency become dependency? And at what point does dependency become power? BlackRock's defenders will say the firm is simply a mirror of client demand. Investors choose cheap ETFs. Institutions choose Aladdin. Governments choose expertise. Infrastructure sellers choose capital. In that view, BlackRock did not seize power. It was handed power by a system that rewards scale. But critics will say that is exactly the problem. If power can accumulate without anyone planning it, then nobody may be responsible when it becomes too concentrated. The next version of BlackRock may be even harder to understand than the last. It will not only be index funds, it will be private credit, infrastructure, data centers, energy transition finance, artificial intelligence partnerships, and digital asset products. The firm is moving toward the places where money meets necessity, and that is where the highest stakes live, because whoever finances the future often helps decide what the future looks like. That is why BlackRock matters. Not because it secretly owns your life in the cartoonish way people imagine, but because it sits behind so many financial decisions that shape the modern world. It is a manager, a platform, a voter, an advisor, a crisis contractor, a technology provider, and increasingly, an infrastructure investor. Each role is explainable alone. Together, they make BlackRock one of the most powerful private institutions ever built. BlackRock began with a humiliating mistake, a young trader learning that misunderstood risk can destroy everything. Decades later, that lesson became a company overseeing trillions, running risk systems, shaping corporate votes, advising governments, and moving deeper into the physical infrastructure of the world. Larry Fink did not build a normal Wall Street firm. He built something quieter, broader, and harder to see. A financial empire that does not need to own everything to touch almost everything. If you enjoyed the story of the BlackRock empire, the company that owns everything, then you'll love the story of the world's most expensive mistake, lost Bitcoin worth billions. Click the video on your screen now. I'll see you there.